Welcome, it's part two to your mega trade. That is right, 100x potential trade. Rarely do I ever discuss leverage trades and timings for specific opportunities that can take you beyond 3 digits, 100 plus risk reward, where someone who understands stop loss placement could trade a smaller structure pattern and extend into a larger structure pattern with a huge target. The risk of the small time frame with the gain of a big time frame, it'll take a while to happen. You need patience. Many will fumble it. That's right, and they will quit the game. It's kind of like being a football quarterback and dropping your first catch in the first 5 minutes and sulking and leaving the field, when in actual fact you had the opportunity to be in the winning touchdown throws in the final minutes of that game and you threw it in. So you need to recognize the most vulnerable period in a key trade is in those first 5, 15, 10 minutes, those first few minutes of the structure. Once a key move takes you away from your entry point and gives some wiggle room and distance on your stop, and you have got the wind in your sails and a macro move with bigger ups and bigger downs that will play out over a longer period time frame, you are in the game. Getting distance between your entry and a tight stop is one of the most important things, and nearly all your very best trades move early in the direction of expectation. One of the core videos on our YouTube channel that auto starts playing is rarely do you ever have a trade that goes against you immediately, dips down, starts costing you money, and then later turns around and becomes this great big winner. Normally your best trades are timing related on the lower time frames, but with a bigger justification for macro moves, and they move in your favor, and the best orders are the ones that see you taken into the trade by the market itself. In other words, let the self-confirmation of the market give it to you. In other words, the movement up through a key level of significance that many may not have seen because you're early, and which is often when there's the real fresh impetus. Young cells are popping and fizzing in that trade's early life, and you get that key initial move that takes you away from your entry point and then puts you in the pound seat to sit and hold. Another key concept that absolutely plays out in leverage trading that most people fail to understand and fail to appreciate. All your best trades, profitable trading, are the trades that are held for long time frames. Your losses should be taken quickly and your winners should be running long. Your winners should be running long. All the most successful traders typically have very short duration on their losing trades, and they can be many, quite a high percent of a pool of 100 trades. But they are 1 unit of loss taken quickly, and the positions that you hold for an extended period are typically positions that have gone green early and continue to move into the green, even though even on the big time frames they will still have sustained periods of take back in a journey. Markets do not travel in a single line. This said, in reset times there are going to be some vast, highly capitulative moves to the downside, and in the anti-fiat category, highly parabolic moves that on lower times will still have pullbacks, but on the bigger time frame, once you are focused on the big game, will be net givers and rainers of cash for an extended period. This trade that we introduced in part 1 on the previous YouTube on this channel was highlighting an in excess of 100 R's. That's right, risk X and get potentially 100X. You get to determine what X is. Remember, something that rewards so greatly may require, in an imperfect world where there can be some schizophrenic movements and smaller time frames, there can be some volatility, may mean you need to risk X 2, 3, 4, even 5 times before you get your final substantial move away from your entry point. If you go in with the maximum you can afford to lose on your very first attempt, you have no room to put it on again a second, a third, fourth, maybe even a fifth time. And let me tell you this, even if we're incorrect on the small time frames and we end up having to put it on a fifth time, the gain and the patient gain with the lengthy run and win in your favor will pay for all those early attempts later. So if you have 5 entries and only the fifth one takes you to the full target where you are getting 100 R's, the 4 before that failed mean you get a 96 risk reward trade. I'm here to tell you that virtually no one, including professional hedge fund managers, including George Soros on the pound collapse, had that level of risk reward that we are giving to you today in this video on this chart. If you value that, and to all the people that leave comments in our YouTubes and on Twitter, looking really forward to one day joining your community, I'm here to say, here's a rare moment where $100 could see you have $10,000 plus, and have plenty change from joining us as full members to exploit, learn, and grow even beyond this. That's right, $100 risk. Now, bearing in mind, you might need to spend that $100 a few times, so it could be $500 risk if only the fifth event. However, I have a sneaky suspicion the key moment is happening right now, and I'm taking you straight to the charts because the falling wedge I just drew has currently slipped. So here we go to the charts. Have a look with me. So this is gold spot, and this is on the 1 hour. When I drew this candle had not broken this red line. As I was speaking to you in that opening salvo, exactly what I thought would happen has happened. We are beginning after a patch of volatility here. You can see the slightly schizo reach for the higher numbers to have a minor pull back that is happening. I've also showed you in the previous video, and I don't intend to over cover this, the head and shoulder tops that occurred on both these localized highs. And what is this showing you? It is showing you there is a key level that is being seen very psychologically. And you don't need to be an absolute genius to work that level out. I'm here to show you the obvious, but sometimes it doesn't always feel that obvious. You don't frame or think like me. I've been doing this for many, many years, looking for massive R trades, focusing on macro technical and looking at the micro technical at key moments and levels when you can get away with that super tight low risk, even if it requires 2 or 3 goes, and then stay long for the better part of 18 months, a year, 10 months, who knows, for that big, awesome target. And you will have extra opportunities on continuations during that period, if correct on the macro, to enter further and to break and enter into that trade and scale up as you are getting confirmation for your view. What does this point to? Gold up. That means difficulty for fiat generally and the dollar during this period. You have just begun the down leg we're warning on the right for the rising wedge, and we expect a dip down, and we are currently going to talk to you about limit buy orders somewhere in that blue box with a final stop somewhere there. In short, what am I saying to you? You are currently a little bit warm, you're going to come off a little bit, and there is a decent chance that this structure, once it's come off, you will be able to buy at a key level of significance, such as 1965, maybe 1968, possibly as low as approaching 1960. I think that's a bit risky to put your limits there. You may not get a fill, and you can have a hard stop over here, and I'll be showing you this level in a minute. Let's get him up and show you the actual levels. Hard stop right there, low 1944. That's right, the end of the war, 1944. Stops below 1944 and entries in this blue box zone for what will potentially be your first ever triple digit risk reward trade. Why? Let's go put that entry somewhere in the middle there. I was born in 1968. Come on in and join me at 1968. That will extend your risk a little bit bigger. You might be able to do better. Maybe we'll just go 66. When did they supposedly land on the moon? Oh dear, I'm getting a little bit too esoteric here, aren't I? So let's put it down here. I personally think you could optimize that stop to down there. That's a little bit cheeky, but you could optimize that stop to down there. And this take profit, we will be taking to 2,905, and again, I think you're going to get a lot of upside on it. So the expectation on the gold trade that could see you do your first ever triple digit risk reward, getting you focused as a trader on money management, risk. How tight can you squeeze it? How big can you extend it? Understand the holding of this trade will be lengthy potentially. The up leg of the bull flag took 13 months, 1 year and 1 month. And you could expect the same a little bit earlier or a little bit later on the subsequent move to follow. However, in my opinion, I think it comes faster and it goes further. So I think you could actually get a pleasant surprise on that framing. So let's go up to the bigger time frame and talk about why this little down leg is the final gift for a lower entry sub 1970, whereby you will get, with a tight stop, the opportunity to leverage long. And the only other time I spoke of leverage trades to YouTubers with low skill sets, and many of them not very clear on how to execute this. And please, this is non-advisory. This is only if you own your own outcomes. This is what I am doing. I am discussing what I and my community of members are doing, and I'm giving you an early peek in the principles of high reward, super tight, on multiple time frame cross analysis risk reward trading. So on the basis of a 1965 type entry, maybe even a bit lower. Let's just see if I can grab that one more time again, get out of the overlay drawer. I think you could get, let's say 1965, there's 1964. I would say you could optimize a stop to maybe there, slightly below there. I would be a bit concerned if we came all the way down and flat. It's not below that stop, it's actually a secondary low there. And that could be your first attempt of possibly more than one to crack into this trade. Only once you get a volatile and an impulsive move above this third high, we call this the third high. Yesterday was March the 30th, the birthday of yours truly, 55. That sounds like some occultic special number, doesn't it? 2 S's. Only when you smash your way through that level could it be for the last time sub 2000K gold. I'm not saying it absolutely will. I listen to people saying last chance 10K Bitcoin for about 3 years and be wrong many, many times before eventually they might be right. But this particular structure will take you higher, and if there is continuation, as we expect from the big structure, which we'll be going to now, you will go to 2,905. So we're relying on the smaller pattern to perform to its target, and it's not yet triggering. The triggering level is just sub the 1990 level. I will give it to you here. I am also going to remind you that the futures roll, the reason I brought in March the 30th is not narcissism. It is the end essentially of the quarter, and there is a futures roll date. So I will show you gold on the futures. This sometimes confuses people because on the gold futures you will have a different value right now. So as you get the futures close, you can sometimes get a squeeze into that futures close as people are wanting delivery. Some exchanges still do some degree of delivery, what they're supposed to do. And as a result, straight after, and you roll into the next quarterly contract, you can sometimes have an easing. And this may well be the case. So the high there, if you look with me, 1987, the year of the great crash, 0.645 is in fact your triggering event. You should right now go and put an alert before that. That will be great news for you if you get your entry somewhere in that blue box as I've illustrated with the stop here. Great. Let's take it up to the big time frames. But before I leave, you see that red line? Where did this red line come from? Let's remind you of the technicals of this trade on the bigger time frame. You see that red line right there? It's got more of a gradient when you start to go up to the bigger time. It is the capping, descending grind line. That is a larger continuation pattern. That is part and parcel of a macro bullish move in terms of what we consider to be a bull flag that saw multiple points of contact at this level. I've got it on the monthly. I'll take it down to the weekly. It's actually a slightly more detail for you. And we'll crunch it up a wee bit and we'll redraw it. There you go again. There is that green bull pole that saw you run up to those levels. That was your foundational peak for the better part of, and that was in 2020, around about July. That was its minor dip in terms of the larger scale of the move. That's relatively minor for the events of March 2020. That was a failed attempt to make a new high with a secondary rally. This was your last point and interaction with the capping, descending grind line, the red line that is running through this structure. This was your pullback that we thought could meet the 1800 or the splitter. In fact, it showed more strength than that and turned a little before and has gone straight back through. So events, dear boy, in terms of the bank, you have triggered this bull flag. What is typical according to HVF method, Hunt Volatility Funnel method, is a much lower time frame winding up process when at a key structural level as determined by a macro technical pattern. So there is something going on in here, and that's where we started this clip. What is going on? Are you going to fractalize something that will commence a small move that could roll into larger dominoes falling that turns into a strong impulsive move that sees you take out that secondary high and the all-time high in short succession and begins everybody suddenly realizing that this is a bull flag and you are now making new highs and gold starts hitting the headlines. This is your invitation to get in leverage trades longer at this juncture and point. And you will notice that risk reward that I drew is right there, and we're going to need to go, and go. So all my draws go out of sync there, and I will pull that reward all the way up basically to 2905. I actually expect you will overshoot that amount by some degree. You might want to do a 75% closure and allow 25% to overperform run. And what is the risk reward ratio on that? Currently at around 60. Could you optimize that further to get that 100 risk reward? Absolutely, you could. We will go back down and we'll see if we can engineer it for you. However, what you have to remember, with every additional optimization where you squeeze this risk, you increase the likelihood of you having to use more entries to get that multiple. So if you said, listen, I don't think we're going to come down to the 1953s again, and I think this little sell-off will come a tiny bit lower and we can try get in at 1962, you can choose to play it like that, and immediately you are on the doorstep of 100 at 1953 stop. You could wait longer after this pullback and it starts basing and returning, much as you got something like a localized low here. As you start to see the wicks and the hammering occurring somewhere here, you could enter in there and put a stop there, assuming that begins to occur there. If that were to occur, you could optimize that risk even further and improve your chances. So if that were to start hammering round about these levels, and you were to get hammers and hammers in this pink circular box area, and it starts to show a real resistance to probing much lower, you could put a stop right the way there and you could enter there. You're knocking on 94 times your money risk. By the way, once you've got your entry and the market moves up and away but is not yet broken yet, where's your break? 1987, the big collapse of the stock market. It's funny when it's in these 1900s. We've got all this economic history and birth dates. It's fun. It makes the numbers stick. Once you're in this level, you can use multiple entries. So you'll have further confirmation that this potentially is an orchestrated and final third low. So it can come like that, and then it starts to dribble back up a little bit. You could then get in again somewhere here, and this time your stop could be there, and you could do an early entry prior to the triggering event that we've put the alert on for over there. So there are nuances to this overall structure, which is a hunt volatility funnel upside on that time frame that is 1 hour, relatively low time frame for us, but a great fractal, all sitting on iceberging, as we often say, a little bit above, a little bit below that key structural flag triggering event. And this is how you overcome key structural levels or minor gradients like the capping descending grind line. First, you resist at them. You just run and you resist at them and you fall back. That's already happened on the flag 4 times, 4 separate times. Then you break through it and start to sit in and around it. It's called saddling or straddling it. The price behavior trades a bit above, a bit below, and hence you get this iceberging, a little bit of above, a little bit of below. And then as you start to straddle, more of the iceberg is actually above the waterline, unlike normal icebergs where you have just a tiny bit testing the level and the bulk of the price behavior below. You start to get these elevated peaks, and this is where we are. And you are getting a wind-up bullish structure that is having possibly its final down leg, that this rising wedge that I thought I would describe for you is likely to break to the downside, began breaking as I was introducing this trade idea to you. Okay, if you want to understand this and more, you should be in a community where you can be helped. Click the first link in the description and you can join the Market Sniper, aka myself, an amazing community of people with multiple of trade leaders, round-the-clock webinars for US, crypto, macro markets, my non-farm, my regular personal video updates and chart shares through a leaders group, which is only for those that are involved in the teaching process and the guidance process. It is non-advisory. You must own your own outcomes. We are not putting your trades on for you. However, there's a real opportunity right now for many people to have an expansive reward to 2,905. You can guess what the headlines will be that will bring a gold run in dollar terms to the doorstep of $3,000 as part of further future moves. By the way, you don't like the idea of trading, you don't want to get involved with that, even if it's a trade you put on once and you leave for 18 months or 10 months or a year, you can invest in the metals, pure gold below, or you can dollar cost average through bullion vault and then get out and take the funds you have made in that profits and secure physical delivered metal to you. Pure gold will deliver to your door, bars, gold coins, silver coins, almost anywhere in the world with very few exceptions. You can also trade with our brokers, Scandinavian Capital Markets and SimpleFX. SimpleFX will take crypto, Bitcoin for you to trade a gold market. You can use crypto to secure, you can use stablecoin. Is there counterparty risk with brokers right now? There's counterparty risk everywhere, my good people. You take it on your own head, but not everything will fail, but many things might. So having a mix of investment and potentially going for gold with a little bit of trading is on your own head if you elect to do it. As already said, non-advisory. This is your update on precious metals. I will do one further thing and I will have a look for you on the crosses on other currencies so that you can see, and I will show you also the futures markets so that you can see that slightly different chart that happens with the futures rollover. See the gap up there? This is a continuous chart of the near-term contract, and you jumped from the one contract to the other, hence that gap. Not a trading gap. This is a continuous chart showing you. You will also notice on the continuous next contract that this went all the way up to 2000. And if you're looking at this chart, you can see again how key levels of significance just run on this 1 hour time frame are showing you what the real iceberging, where you get small elements of stick through your water level with the bulk of the iceberg below the structure. And 2000 is it, my friends. This entire structure is a wind up post the triggering event of a macro bull flag to run and hold above as new support. So you might think resistance is a terrible thing. I don't like it when charts bump into resistance. Resistance is your gift, because after a level has served multiple times as resistance, in short, it is a strong anchor hold for that underlying market. Once you smash it to the upside, it now has your back as support and defense. So what frustrates you now is your gift later. The markets love you. The markets want to give you opportunities. You do not know how to read and interpret the charts. This is a land and a world of abundance. Everybody here is wanting to preach to you scarcity and difficult decisions and lockdowns and freedom takeaways, all as a result of a culture of end of climate, end of planet. They are the doomsday preachers. I am not the black pearl doomsday preacher. I am a man of abundance. There's abundance of food. There's abundance of everything. There are issues with people that do not want to, that want absolute power. You have a chance to knock the ball out the park. You must decide if you want to put this on. Click the link below if you want to follow this and book a chat in terms of how we are investing our 25%, 25%, 25%, 25% portfolio of crypto, precious metals, equities, and real cash, hard cash that can't be taken out of the bank. You can find out about this and more when you book a call. Thank you for watching. That's your futures. We will see you again as we monitor the progress of this trade. Till next time, bye for now.